Real estate is booming. Oh yeah, you can win big, but you can also lose. There is risk with real estate investing, and that's the reality no one's shouting about. Learn about how everyday investors lose as well as win here on Truth About Real Estate Investing show. Since 2016, nearly 300 episodes, all over an hour long. And before that, I was blogging since 2010, weekly. The market has done a very good job of taking care of us long-time real estate investors with over 10 years experience of actively burrowing, investing, and continuously improving. It's honestly, the truth is, it's only the recent high leverage get rich quick schemes that have caused investors to go bankrupt, including going bankrupt in 2021 before the market even downturned. So their own investing operations, business operations failed them, not the market, not interest rates, nothing like that. And the organizations that those coaches, students belong to, they simply swept them under the rug. Fortunately, there are many good people out there and good investors out there who are willing to share what works and doesn't work on this podcast. And also understand that we do have off-the-record conversations as well, which really helps me filter out the noise as to which courses, coaches, strategies are good and which are not. And the whole point of the show is to highlight how to achieve predictable, repeatable success real estate investing versus the hype and shiny objects. Also to keep you update on the current events relevant to Canadian real estate investors. For example, in the US, all eyes are on regional bank PacWest, whose stock has collapsed 75% since March. 75%. They've lost 3/4 of their value since March. As there's fear that this is the next bank that will fail. There's a couple other banks that are in similar situations. What do banks in the US and internationally have to do with us? Traditionally, bank turmoil leads to bailouts paid for using debt, government debt, and cause falling interest rates. I've included a chart in the show notes of the show. And just to explain what I wanted to highlight in the chart, if you look at 2020, so only 3 years ago, before the pandemic, the U.S. federal debt payments, so interest expense related to their debt, has increased 50% in just over 3 years. 50% from 600 billion to 900 billion. Those are their interest payments. Keep in mind, when governments have excessive debt, an investor's best defense is hard assets. And my clients and I choose real estate income properties, and in doing so, we've made millions. Just truth about real estate investing. When interest rates decline, we'll see more fuel added to the fire in the real estate markets and properties we already target, where everything is already selling quickly. We are in a pretty heavy seller's market already. The bond traders that predict. So I use a tool called the CME Group, FedWatch tool. So it aggregates and analyzes what the bond traders are doing, and bond traders are predicting rate cuts by the U.S. Federal Reserve starting this September of 0.25% and subsequent 0.25% cuts each meeting after that, for a total of 2% in cuts by the end of 2024. Again, I've included a chart in the show notes as well. Again, this is what the bond market's saying. These are not my predictions. I use pieces of information like this to form my own opinions. For those on our email newsletter, the show notes and chart will appear in your email inbox if you're among the already 10,000 plus Canadians who already subscribe. Sign up today to receive timely updates on our new podcast episodes, and you'll be the first to know about upcoming events like iWin free trainings and mastermind tours that you do not want to miss. The tours especially, they sell out usually within just a few days, and those are really highly valuable. Our newsletter is the perfect way to stay connected with us, to stay informed about all the exciting things we have in store. So don't miss out. Sign up now. Join our community of engaged and informed 17 listeners. And if you're new to the show or old to the show, we do have a few more than 17 listeners. We're actually closer to 20,000 downloads per month. So if you're interested in joining the community, www.truthaboutrealestateinvesting.ca, and then you'll start receiving our newsletter. You'll be informed both about real estate investing and the events that we have going on. www.truthaboutrealestateinvesting. Enter your name and email address on the right side, and you're good to go. And as always, we will tell you how it is to be an investor of Canadian real estate. On to this week's show. We have Matthew Lee and Ming Lim, the owners of a full-service real estate business called Volition Properties. They happen to also host the largest meetup in Toronto. And if you can believe it, them and their community successfully invest in Toronto, mostly small multifamily. Again, so we're not talking about condos. We're talking about small multifamilies, duplex, triplex, fourplex, fiveplex, and up. And do understand they do require significant renovations. Significant renovations require, capital to invest, preferably cash. And so Matthew and Ling detail how they add apartments to existing buildings, including laneway suites. And they've been doing all this since 2012. If you've invested in the right way since 2012 in downtown Toronto, if you avoided all those shiny things about other countries, including provinces, including ones that are oil rich, if you compare an oil-rich province versus downtown Toronto investing, there's really no comparison. You'll likely be very rich, like these guys are, and their clients who've collectively added over $100 million to their net worth. Volition offers advisory services, investment realty services, design and renovation, and property management services. On top of that, these guys both have good-sized portfolios, wives, young kids. How they do it, I don't know. Obviously, you have to be pretty bright, so let's find out together. If you enjoyed this episode, Volition is hosting a meetup on Wednesday, May 17th. Doors are at 6 p.m. I don't think the meeting starts till like 7-ish. It's on the Danforth. So if you're downtown, you're on the Danforth. I think that's pretty easy. I'm not a Toronto guy, but I know enough. I know it should be pretty accessible by subway. Link is in the show notes to register, and the keynote speaker is someone you do not want to miss. Link is in the show notes. If you're on the email newsletter, then you'll see it there. So please enjoy the show. Hello, gentlemen. What's keeping you busy these days?
Geez, a lot. We're actively trying to run this Toronto investment realty business. That's got me working 12-hour days, 14-hour days.
14-hour days.
Yeah.
How's it half that time spent?
I'm only
traffic?
Yeah, right.
Well, especially since he lives out in the boonies, actually.
Yeah, I live out in Aurora, but I'm a country, boondogging type person.
So you drive into the city to work?
Yeah. Okay. I don't go in too often, maybe 2 or 3 times a week. But yeah, spending it's a long time in the car.
Right. Yeah. So it's been a long time since seeing you guys in person. I think it was before the pandemic, since I last saw you in person.
Yeah, I mean, all our hair colors have changed since we last saw each other. Yeah. I'm heavier. You used to look good, dude.
I just gotta eat less, that's all. Can't afford it. At these interest rates, you can't afford to eat.
I have a lot more bags under my eyes since we last saw each other, too, because I've a couple of kids in tow now.
Yeah,
so.
Yeah. The story I share is that before kids, I always get carded.
Yeah.
As soon as I had a kid, I was 33 when I had my first kid. As soon as I had my kid, I was getting carded.
Yeah.
So my kids are a little bit older than yours, but so.
I'm still wiping bums.
Yeah. You're still wiping bums?
Yeah, and that's my own, actually. So.
Yeah, be glad you're still young enough to wipe your own bum.
Yeah.
We're at the stage where we talk.
2 minutes into the podcast, are we off the rails?
Yeah, we lost at least half of our 17 listeners.
Yeah.
But they should listen to this because you guys have been actually making money in Toronto.
Yeah, I mean it is.
And we're talking about Toronto proper, not
proper.
GTA business, nothing. No, we're talking about. Well, actually, what are your boundaries?
So
Streets,
I mean, generally we're staying in Toronto proper. So that is the original Toronto borough, not North York, not Scarborough. We dabble in East York, we do quite a bit of East York and the central of Toronto, but we won't go out to Etobicoke. This is for investment purposes, right? But we are very centrally located, and that's driven by the way that we approach things. When we started the business, we were all investors in other places. We were doing Edmonton's and Sudbury's and you name it, whatever was flashy at the time, we were investing there. And then
there's lots of flashy things.
Oh, there's
lots of
shiny objects, and we were chasing all of them, right? And we were looking at the returns and also the tenant profiles, and I think it was through you started listening to a bit of Grant Cardone, and I remember thinking to myself, how can I 10x this business? And then I'm like, do I want to 10x this business? I'm I was in Waterloo at the time, and I was I had 20 something doors, and it was I don't want more of these tenants. I can't manage it. Like I was already working so much to try to manage that portfolio. So we started focusing more on Toronto, and that was more in our wheelhouse. Tenant profiles were just easier for us to manage. We started looking at, what they wanted and developing a business model behind the tenant profiles that we wanted. And yeah, that's how we landed in the city.
Right. So that's generally how we, Volition, as a real estate investment advisory and realty business, we looked at things a little bit differently. Most people are chasing ROI. They're chasing cash flow. They're chasing returns and what have you. And of course, ROI is a really important component to consider, but not in isolation. So it's really funny. In finance, there's this concept of risk-adjusted return on capital, RAROC. That concept, for whatever reason, doesn't exist in real estate. So what Volition aspires to do is actually bring a risk-adjusted return on investment mindset to our investing, as well as a headache-adjusted return on investment.
I jokingly call it return on grief. I need a high enough number for
we grief. Say the headache, grief, it's all the same thing. If you're spending time, energy, headspace, effort dealing with tenants, LTB, whatever, the lower my return actually. And so what that's all culminated in is the Volition investment business model, which is heavily predicated, as you guys were talking about, in and around the downtown core. So in a nutshell, essentially, we have a business model that actually works in Toronto. It is a small multifamily business model, acquiring freehold houses, multifamily, in the residential neighborhoods adjacent to the downtown core. So this is very much Toronto proper, 416, and in these really, really cool, funky neighborhoods that are gentrifying, that are super hip and super attractive to this young tenant demographic, professional millennials, university educated, 2 to 5 years out of school, making 60 to 80K, working at a big company in downtown Toronto. Yeah, so that business model does work, and we're one of the few investment realty teams that does make it work here in Toronto. Not here in Toronto, I guess here is Oakville now. But
the listener doesn't know where we are. We're in the CN Tower right now, in case anyone doesn't know.
Right. Broadcasting.
Nice view up here.
And the investment model has changed through time, right? Because when you guys started, I'm sure the property that you targeted in Toronto was different than what it is now. So can you start with what it was when you started?
Yeah,
what did the property look like? What it cost?
I'm sure it very much parallels your own investment journey when you were doing like a duplex and you were paying very little for it. For us, I think it was probably starting at around like $600,000-$700,000 when we first started getting into these things, and a duplex would cash flow back then if you were in the right neighborhood. Now we have, now kind of the minimum is a triplex, but we have a lot of clients doing more advanced things. So let's say buying it residential as a 4, adding units, exiting on commercial financing with CMHC financing, better rates, longer amortizations.
Is it that program that everybody's talking about, the CMHC, the
MLI Select?
Yeah, everybody's talking about it.
Yeah, we have a client right now who's doing exactly this, taking small multifamilies or even single families, turning them into 5plexes that could be 4plex plus a laneway, for example, and then exiting on commercial CMHC financing, MLI Select, and MLI Select is getting 4.34 on the interest rate in a 50-year AM. Once you're into those types of numbers, your cash flow goes to the roof. So this is why, you have to be a little more sophisticated. Yes, we help people find turnkey too, but turnkey has a lot of competition, has certain limitations. If you're a little more sophisticated and you know how to make Toronto work, Toronto can work for you.
How many doors do you need to have for CMHC, the Select program?
You need minimum 5. Yeah, and then part of it is you have to hit 100 points. A combination of energy efficiency improvements as well as
affordable housing.
Right. Yeah. So if I was a brand new investor and I wanted to do one of these, say I had the financial capacity for this, and the mental.
Because that was my first question. How much money you got, Irving?
I'm a millennial. Instead of $100,000, I've rubbed all my pennies together. Got $100,000. No, I'm kidding. Yeah. Actually, no. That's actually a good question. Mm-hmm. What should what should a to be successful Toronto investor, what should they come to the table with in terms of resources?
Yeah, it's a good question. I mean, we get people coming from all sorts, everything from like, C-level executives down to, somebody fresh out of school. And, one of the things I think we pride ourselves on is we're not a traditional brokerage that, you want to go buy a condo, here's a condo. We go through an advisory process, which Matt runs, and sit down and kind of devise a plan depending on where you're starting and where you want to get to and how to actually get there. And, real estate's involvement in that. So it's a bit of a wishy-washy answer. It depends. But if you're, what we're trying to get people into is eventually single-family housing. Single-family with multiplex, right? Not to be investing in condos, though that might be a step for them along the way. But I look back to like one of our staff. She started off, in a condo, then went to live in a triplex, refinanced that triplex, got into another triplex. So now she's got two. Refinanced one of those, got into another house for herself, which is now turning into a duplex, and bought another condo along the way. And that was in about 5 years. So that's like, we help people graduate through the properties that way, because otherwise there's no other way to do it. It's not like people are saving up hundreds and thousands of dollars. It's all about the equity, right? So as equity grows within the property, getting that back out so you can go acquire something else.
Because we all come from the same learning that it's all about cash flow.
Yes.
Remember those days?
Yep.
The rain days.
Yeah.
I remember.
There's
There's the 8 to 10% rule. There's
I remember. So one of the stories that always really sticks in my head, one of my like life lessons was, I found a property in Waterloo, and the typical cash flow for it I was looking at the time was like $200-300, and I found this place was cash flowing like $500-600. It's like double the cash flow, right? And I was like super proud of myself. I took it to my mentor and I was like, hey, like look at this deal I had found. I've beaten the market. I've found more cash flow. And he turns to me, he's like, great. So what you gonna do with that? You're gonna buy me dinner? And I was actually like really taken back because I was like really proud of myself that I found. And he's like, so what? You've got an extra $200-300. He's like, is it in the right locations? And he started just drilling me like, who's your tenant profile? What's it going to look like in 10 years? What's the transit going to be in the area? And I was like, whoa.
Because real estate ain't done on a spreadsheet.
Yeah.
And I think that is the...
That's a good quote.
That is a good quote. You should trademark that. But as we've matured in our strategies and our thinking, it has matured past just cash flow. And it's funny, I'm looking at that book by Julie Broad.
More than cash flow.
Yeah. Is it Julie Broad? You wrote that? Yeah. And so like I remember reading that back in the day too. But really, it is more than just cash flow. It is really about equity, and it is really about understanding. So I get a lot of people come to me. I run advisory, so I get a lot of people come to me and they I ask them, "What are your goals?" And they come to me and they say, "I want 10 properties." I'm like, no. I didn't ask you how many properties you wanted. I asked you what your goals were. Because what we do at Volition, what we do during advisory is we want to understand where people are at, their starting point. We want to understand where people want to go, and then help them build a plan to get there, which is a lot different than, excuse my vulgarness, throwing shit against the wall and seeing what sticks. Mm-hmm. And I think that's how most...
Because we've tried all that. We've thrown lots of shit.
We did lots of shit. And then we like play in our shit and, throw shit.
Try to justify our shit. End up selling it.
Yeah.
No, I mean like divesting.
Yes.
But we get a lot of people who just say like I want 10 properties, or I want maximum cash flow. I'm like, no. I'm like, no. Like, first of all,
refer them to Erwin.
First of all, if you're looking at Toronto, those are opposite concepts here. But generally speaking, it's really understanding where people want to go, because there is no one size fits all investment. Even in Toronto, as much as we have this multifamily business model, triplex, fourplexes, maybe laneways, catering to a specific tenant profile, and all the rest, there still is no one size fits all type of investment. And so it's really about understanding what their goals are, and then once I understand what those goals are, those life goals I'm talking about, what we used to call beliefs back in the day, we can translate those into financial goals in support of those life goals. And once I've translated those into financial goals, I can translate those financial goals into real estate goals, and I can help them build a real estate plan to get there. And so that's all part of our advisory process, but one of the concepts I want to narrow in on is what you were just talking about, that we were discussing actually in the preamble beforehand. It's around equity. And that's not a concept that was taught to us back in our education days.
Yeah,
Remember
we're going after cash flow.
Yeah, we were like, oh, cash flow. And then it was okay, $500 per property. Okay, if I want $5,000, that means I need 10 of those properties. Like that literally was the formula back in the day. We teach something a little bit different now. And what we teach people is...
Oh, sorry, just pause you there.
Yeah.
It's not like $500, $5,000 cash flow is a bad thing. It's just not realistic.
It is like basically...
Not without a ton of cash.
And and you know, which led you down the concept of joint ventures because you're going to get tapped out and all those other stuff. Right? But yes, absolutely. Like we think of things a little bit differently now, and the way that we think about it is in terms of equity, and it's really understanding the relationship between equity and cash flow. And that's not something that we understood back in the day. So what I like to ask some clients now, new advisory clients, is okay, what does Albert Einstein have to do with real estate investing?
I have no idea.
He doesn't even know.
I haven't gone through one of his advisory sessions recently.
He hasn't been a client in a long time. What does Einstein's theory of relativity have to do with real estate investing? E equals mc squared.
Yeah.
What does E stand for?
Energy.
What does M stand for?
Mass.
What is that equation actually telling us?
I'll
fail my science. You have to
here.
move mass to create energy.
It's saying that matter and energy are two forms of the same thing. And through this relationship, E equals mc squared, I can transform one into the other. Now, similarly, in real estate, if you understand the relationship between equity and cash flow, you can actually transform between the two. So if I built up a whole bunch of equity, then I can then translate that into cash flow. And so one of the ways that we do this is we have the Volition multiplier effect. For very sophisticated and seasoned investors, this is not going to be anything new, but we start off with maybe a Toronto $1.5 million triplex making $7,500 in rent, and basically around cash flow neutral. At 5% growth, which we think is fairly nominal for Toronto,
especially with inflation the way it is.
Right? And that's actually less than the Canadian average over the past 30-40 years, right? 5%. We just model at 5%. At 5% growth, in 4 years, you would have built enough equity in that property to do a refinance, equity takeout, and go buy another like property. And both properties are worth about 1.8 at that point in time in 4 years. And then rinse and repeat. Keep on doing that. Imagine you reach a certain point, year 12, and you've got maybe 8 of these places. Great, right? Then what do? When we say, okay, maybe we wait. How long do we wait? Maybe 6 years. Why 6 years? In 6 years, at 5% growth, you reach a magical number, 50% loan to value. 50% loan to value means that I can sell off 4 of those properties and pay off the mortgage of the other 4. And now I'm left with massive and life-changing cash flow. Not the couple $100 here and there to take your mentor out for dinner.
Yep.
This is massive life-changing cash flow to the tune of, and the Volition model will kind of explain all of this, but to the tune of $500,000 plus cash flow per year, right? And then we've started leveling up even past that. Now we're teaching clients. So I sold a few properties for the first time. I had money for the first time in my life. Every time I had money, I would always go into real estate, so I was always poor. All of us were probably in the similar boat.
I still do that, yeah. That's why I'm poor. So I'm not eating and look skinny.
Right. But what we do now is we actually take the net proceeds from our sales. Instead of paying off the mortgages of the other half of the properties, we onboarded with private wealth for the first time ever, and we discovered that private wealth has access to financial products that normal retail investors don't have access to. One of those things is structured notes. Structured notes offers a double-digit return, a fixed income return, and essentially we take those proceeds, put them into notes. That in this Volition model, it would boost cash flow from about $500,000 to $900,000 a year. in something. In this is all a framework. This is not any one particular person's plan, but to illustrate the concept of why equity is so important and focusing on not instant gratification now, the couple $100 of cash flow now. It's about the massive life-changing cash flow later, and that's where Toronto comes in. So Toronto offers a vehicle to allow this to all happen, because really it's about just buying solid risk-mitigated properties that are low headache, that allows time to do its thing. And then if time can do its thing, it can be the vehicle to help you reach those life goals.
Right. I actually know quite a few investors that bought in like small town Ontario that none of us could name. and their greatest regret was, I wish I bought near a bigger center, because even though they got cash flow, 300, 800 a month or whatever, they missed on all the equity gains that we all got.
It's the equity gains. It's also the risk mitigation. When you're buying in a small town, one of the biggest challenges is what's going to happen to this town. So if you look at industry over time and how our economy is changing, we're changing heavily into a lot of professional services types of industries, and it may not be the sawmills and auto manufacturing and stuff we used to do in the past. Moving toward the future, this is why when we start looking at Toronto, there's the Microsofts and the Amazons wanted to come here, and so on and so forth, the Googles and what have you, and those knowledge workers, the professional employee base, really for us it makes sense because they're all coming to Toronto when their headquarters are there, and that risk mitigation is therefore in place for Toronto. And it's really funny because if you talk to a non-sophisticated investor, they'll look at a price tag of 1.5 million and go, oh, that's too expensive, therefore it's too risky. Actually, sorry dude, that's not how risk works, actually. Price is what you pay, value is what you get. Yes, it's an expensive price tag, but it doesn't mean it's risky. That's not how risk works. Right? So that's part of the risk mitigation strategies that we employ at Volition when we're looking at these types of investments.
Yeah, I remember talking to novices, and like they want to buy in like the crappiest part of Hamilton, and I asked them why. Because it's cheap.
Yep, cheap.
$60,000 for a house. Like, yeah, but your risk is way higher.
Yeah, absolutely.
Like the property managers won't go in that neighborhood. You're gonna get the worst tenants because you're right next to the steel mill, right? So your vacant's gonna be high.
A lot of our clients, so due to the fact that it's Toronto and the price tag, the barrier to entry is obviously higher. Generally, our client base is of a higher socioeconomic demographic. So, senior directors and VPs and CC execs and partners or senior partners at consulting firms or accounting firms or small business owners. And so a lot of these people already understand the relationship between risk and reward, so we don't have to explain it.
And they probably want less headaches too.
And they want less headache as well. And so, the business model accounts for all of that.
Right. Can you share with the audience, like, how are they financing properties? Are they still using HELOCs, or these guys are that rich, cash rich?
It comes through a variety of sources. Usually, the majority of our investors are between kind of 35 to 45. So they're not early career, they're not early to investing in general. So they're sometimes pulling them from stock portfolios. So a bunch of our clients have stock portfolios, and they may be borrowing against that stock portfolio, for example, with the bank.
Leveraging it against the portfolio, not having to divest the portfolio.
If you're in private wealth, you can do stuff like that. They'll, depending on what you're invested in, you can get like 80% loan to value in your stock
Never
portfolio.
come up because it's all real estate.
I know.
That's why I have no personal experience.
I hear you. I'm listening to this.
But yeah, that's so some people are doing that. Some people have primary residences that they're pulling money out of. Some people do have a lot of cash, but most people are leveraging something, either real estate, stock, some other way that they've made money.
There's another one. So I work with a lot of clients who, again, our profile is 35 to 45, maybe 50, and they themselves are part of this kind of sandwich generation. Most of us are part of the sandwich generation. Young kids, aging parents. Let's focus on the parents for a little bit. So one of the questions I normally ask clients is if you're not one of these people who have $350,000 you can't find it by reaching down into your couch cushions and finding that type of money, then and your stock portfolio or whatever is not the place where you can come up with the capital available to invest. One of the solutions, and it's pretty funny to think about this, if you're in your 40s, bank of mom and dad. But not bank of mom and dad in the same way that a young 20-something millennial would ask bank of mom and dad. 20-something millennial wants to go buy the first condo, and okay. But actually, one of the things we've been thinking about is utilizing a boomer parent's primary residence, and the primary residence of that boomer, call it in Toronto, call it a $2 million house that's paid off, right? Just for ease of math. I think average probably be closer to 1.5, but let's just use 2 million for shits and giggles. So imagine they bought this, 40 years ago for like 40 grand, right? And it's funny.
I need parents like this, by the way.
anyone willing
anyone
to be
adopting?
A parent? Yeah, anyone adopting. But boomer parents, there's a really interesting financial product out there that might be of interest. And boomer parents who have a property that's been paid off for a long time now it's worth $2 million, let's say. There's a product called a reverse mortgage out there, and the reverse mortgage has a really bad rep in the States, but operates a little bit differently here in Canada. I won't get into the differences, but I'm going to talk about the merits of it and how this actually works. Are you familiar with it? Have you come across it?
Only comes up just what I've read. Like generally, people that are a bit on the elderly side, and they're retired, no other income.
Yeah, that's a pretty typical example. So using it to supplement income. Imagine you had an old Italian grandma who had a house in the annex, and now it's worth like $2.5 million, and she can't even afford to pay her own property taxes. Yeah, property tax. Stuff like that. So it's used very typically in examples like that. Drawing equity out of the home in order to subsidize a lifestyle, maybe subsidize the pension, maybe to allow people a more comfortable retirement, maybe pay for care as they continue to age.
In advance on inheritance.
Exactly. But the way that we're looking at it is through an investment lens. And so an opportunity like this could be very substantial. Actually, quite a few of our clients are employing opportunities like this. What it is a boomer parent's home, call it worth $2 million. Say that their age is over 65. I forget all the exact LTVs, but if I recall correctly, I think at age 55 and above, you qualify for I'm going to say 30% LTV or something like that. And then
very low.
60 qualify for 40%, and 65 is 50%. My LTVs are a little bit off, right. But the point being,
that's pretty conservative.
It's very conservative, and the kicker is no mortgage qualification. If a boomer parent wants to qualify for a mortgage and do an equity takeout or a HELOC, generally it's very difficult for them because they don't have an income, right? And so that ends up being really difficult to access the equity in their own home. People always say, "Oh, can't eat equity, can't eat equity, can't eat equity," but understanding
3 times like that.
Yeah, exactly.
My hot tub I bought was, I can't eat it, but equity paid for it. Sorry.
So I thought you said that you were eating craft dinners and stuff like that.
that was from the boom. Now we're on the bus. So. No, but it's been coming up very often on this show, real investors, people we all know from the community, and it's coming up regularly. No one's eating cash flow because no one's got it, right? Because the projects you're talking about, to do to renovate a 4-plex and build a garden suite, there's just money going out the door all the time. Okay. Who's eating?
That's sure.
Right? The eating's on the exit or the refi.
That's right.
Right.
But so on the opportunity here,
and same with grandma's house. The eating's on the refi, on the mortgage, on the.
It's equity. It's still the equity that they're drawing out. Yeah. This is just
and you can eat really well off of it.
This is just a very sophisticated way to access that equity. So a few of the key points. You can get up to 50% loan to value with no mortgage qualification. So 50% loan to value, no mortgage qualification. Here's the kicker. No more monthly mortgage payments. No monthly mortgage payments. All the interest is capitalized until passing. So think about the opportunity here. if grandma, or I guess it'd be not grandma, just mom, for our kind of like Gen Z type, not Gen Z, Gen X, type client base, their boomer parents or our boomer parents could access $1 million of equity out of their property, no mortgage qualification, no monthly mortgage payments. Yes, the interest rate's a tiny bit higher. It's like 7.5% instead of like 6% or something like that. But not overly burdensome. Not too far off like B lender rates, right? So can you imagine $1 million takeout? If they were to hand that money, this is not Bank of Mom and Dad in the traditional sense. So hear me out. If they were to take that money, hand it to their Gen X kids, those Gen X kids, maybe if they were having problems come up with the down payment and or mortgage qualification for a $1.5 million triplex, maybe they could still qualify for a $500,000 mortgage though, not a $1.2 million mortgage. So the $1 million takeout becomes a massive down payment towards that $1.5 million triplex, $500,000 mortgage, massive cash flow because the financing is so low. And if we work out the math, call it $7,500 in rent and call it maybe $1,000 of expenses. So $6,500 left. Call that mortgage payment like I don't know $3,000 or something like that. Right? You still have like $3,500, $4,000 of positive cash flow. That positive cash flow could be kicked back to the boomer parents to subsidize their lifestyle in their retirement, right? And so it can be a win-win. Structuring it like a win-win is the key. So it's not just a handout from Bank of Mom and Dad to the Gen X, their adult children, structuring it like a win-win. And so the beauty of this is that all this is going to go to the kids typically anyway upon passing. The interest gets accrued, and then the reverse mortgage just has to be paid out upon passing. And really, it's just going to be an asset handed down to the kids anyway, normally. So you have an appreciating asset. The family home is going to continue to appreciate. Yes, you're going to have debt that's going to continue to accrue. But more importantly, I was able to acquire another great asset and have really good cash flow and help my parents at the same time.
Right. And potentially house hack. You can live in the triplex.
You can house hack it. You can live in the triplex. You can generate additional rent. You can subsidize your own cost of living. There's lots of great opportunity here.
You live in the triplex now. You can Airbnb the other suites. I don't even know. I'm not a Toronto person.
There's some restrictions on Airbnb, but generally speaking, house hacking is one of the ways that a lot of our clients get onto the property ladder as an alternative to a condo. And we've shown that it is a viable alternative to a condo. Same down payment, same closing, same carry costs. Right.
And then the cost to the grandma, grandpa. Yeah, I read in the Globe Mail just a few months ago. I'll find you that article as well. But it's the cost to them is the same if they give it to you today versus they give it to you after they pass.
And one of the things, if you talk to wealth planners and private wealth managers and stuff like that now, one of the things that's starting to come up, and I appreciate this too because my wife works in, she has a PhD in gerontology, and so she works in like aging and care. And one of the things that's starting to come up for these aging parents is a living inheritance. So you referred to that earlier. Rather than just upon passing, give it to them now so that they can see them enjoy it and appreciate it now rather than later. And then in the context of real estate is going to be more affordable now than later as well.
Yeah, because I've shared my story on the show. Like each of my kids have a house already. I bought them each a house. Cherry and I bought them each a house before they turned 1. But then just I don't know. More recently, I thought about it. I'll probably get a pretty decent mortgage on it as well. So at least they have to pay like $2,000 a month or something, instead of what it would be if they bought it would be like $8,000, right? So they have some sort of pain,
some responsibility.
Right? Yeah, because like my mortgage is big, and a friend of mine in Toronto just bought a house, 2.8.
Yeah.
So his mortgage is going to be like 5 digits monthly payment. I mean, right?
Yeah, that's crazy.
Yeah. So my point is that I want to wind that down to like $2,000.
Yeah.
Something more digestible and like something that that's something that's going to break them.
Yeah. What did Bill Gates say? I want to leave my kids enough that I feel that they could, so they feel like they could do anything, but not so much that they feel that they can do nothing.
Do you know what the amount was?
10 million. But for him, that's a drop in the bucket, right?
Yeah.
lot of directions I still want to go. Can you walk me through like a recent Toronto deal?
Sure. So right now, we did one just a couple of weeks ago. Downtown near kind of DuPont and Dovercourt, for those who are familiar with the city. Turnkey fourplex, very nicely renovated. We picked up for just under 2.5 million. That was trading at a 5.2% cap.
As is, or did you do work to it?
Completely turnkey.
Did they advertise it as 5.2?
They did, and we did all our due diligence, and we took it at just under 5.2 when we're all said and done.
5.2. Okay, I'm getting the digits mixed up. The purchase price was 5.
Purchase price was 2.5.
Yeah.
Cap rate was 5.2.
Right.
Transposition. Yeah. How often does that happen? Well, their cap number is accurate.
It doesn't. It's not super often because and not because the cap numbers aren't accurate. It's because true turnkey is not really turnkey, right? Most of the properties that we look at, which are turnkey, are really like 70 to 80% ready, and you still have maybe 40, 50, 70 grand to put in to really get it maximized. Not a bad thing because sometimes that means a better deal for you. But yeah, they do occur. We did one the month before that, which was actually an even higher cap. That house had more problems though, like bathroom needed to be fixed, stuff like that. But they exist. I think we've seen a rise in trading caps because of interest rates, right? Like houses aren't going to trade if they're in the low 4s right now. Nobody's going to buy them, especially pure investment properties, right?
So residential investment real estate was in around the 4.25%, 4%, even like 3.75, 3.75. But then, with the change in the environment in the real estate market, we are seeing kind of high 4s and low 5s now.
Yeah. And we're trying to get trying to buy these directly from developers now because we have clients lined up who are looking to buy. Right. If we can find something that's in a 5 cap, people are happy to buy it. So if there are any developers on the show who want to hit us up, we're always happy to talk.
So these are small time developers.
Yeah,
right?
yeah. We're not looking for big stuff. It's usually people looking like 4, 5, 6 units max.
Usually, hopefully, still with residential financing.
Yeah.
Because that's usually advantageous. But if we can make it work even on commercial because we know how to get to. If it's not legal, we know how to get to legal so that we can get it to CMH, commercial financing, CMHC, and then CMHC insured without the MLI Select program is about 4.25 on the interest rate and a 40 gram, not a 50 gram. So it's still pretty good. It's just not quite as good as the MLI Select program.
Mm-hmm. So how much for this fourplex? Oh, sorry, you said 2.5.
Yeah, just under.
What kind of down payment did someone bring for that?
He put 20% down. Yeah.
That's it.
Yeah.
So
that was in residential. So maybe not a typical deal then because he's doing well, so he can qualify under regular residential financing.
Right. So they're not trying to live off this cash flow.
No, because even at that cap rate, cash flows. There's very little cash flow there, right? It is minimal. It really is about acquiring a turnkey property. He's a super busy guy, so he doesn't have time to manage it. He wants something that's going to be trouble-free for his property management company, therefore trouble-free for him, and to let it build equity over time.
How much does property management service cost in Toronto?
We have a really good deal that we have with one of our partners. We're paying $400 for.
It's actually flat. It's actually flat rate.
Fee.
So typically in smaller towns, 8 to 10% of rents is pretty typical. Right?
Yeah. Rents have gone up a lot though. I need to renegotiate this.
So we've negotiated. We have a flat rate actually. So I think it's like $325 for triplexes and $390 for fourplexes. Yeah. So it's it ends up being like 5%. Less 5% or less than 5% in a lot of instances.
Wow.
They don't take on any property though. That's because we're giving them volume. We're also giving them a certain type of tenant profile because everybody who's spending $3,000 on rent in the city is a certain type of professional and whatnot. They're not trying to scrape their money together.
So they follow the properties that they take on happen to be properties that they have a very similar ideology and investment business model. So they want headache free as well as much as possible, and so all the properties that they have to be located in a certain area, catering of a certain quality, catering to a certain tenant profile.
Right.
And so that's why they're able to keep their rates a bit lower, is because of the headache factor.
So go back to this fourplex example. The inherited tenants, you kept them all?
Yeah. In this case, we did. Usually
Nobody keeps
don't.
usually
most guests don't keep them.
absolutely.
don't.
Most of the time, you want
We
vacant
don't
possession
even-
because typically it's under, they're under market. But in this case, we did some due diligence, and we decided to inherit all the tenants. So.
The tenant due diligence, were you able to do that during a conditional period or anything like that?
Yeah. So this was about a month ago before things started getting really crazy in Toronto. So we did have a conditionary period to do all these things.
Yeah, the nice days. But they went away fast, didn't
Oh,
They went
yeah.
very fast.
So I have a lot of clients now. They're crying over spilt milk. We told them last year.
We're like, bye.
You know who you are. We're like, everyone's like, oh, I don't want to catch a falling knife. And like, the thing is, like, you and us, we study like economic fundamentals. We understand that interest rates are just a market influencer. They're not an economic fundamental. Most people don't understand that, though.
Yeah.
And
This
so,
isn't stocks.
And so, like, I spent a good part of last year talking people off the ledge. Basically, everyone's like freaking the hell out. And I'm like, okay, we got into this business model for a very specific reason, and the economic fundamentals are there, and the long-term prospects haven't changed. So why are you freaking out, right? And so last year was a lot of talking people off the ledge, and then a lot of people were apprehensive, even though it was presenting a really incredible opportunity. We knew that this was going to slam shut once there was stability back in the interest rate environment. And so we not that we had a crystal ball, but we said once Bank of Canada, once the back loan, once they say, okay, we're going to stabilize interest rates, what's going to happen? Because this is where most newspaper headlines got it wrong. Not wrong, incomplete. They said, oh, the higher payments are making people not want to buy. That's only partially true. The other part that they neglected to mention is that buyers did not want to buy in an environment of uncertainty. They didn't want to buy in an environment of uncertainty. So, as soon as we got back to a more stable environment from an interest rate perspective, that immediately got reflected in the real estate market. So the 40% less sales volumes in transactions last year, those buyers, at the end of the day, it was still Toronto, those buyers didn't disappear, they just moved to the sidelines. And as soon as they saw stability back in the market, they all jumped back in. Not going to say all the 40%, but a crap ton of those 40% of people are back in that market right now, which is why we're back to 22 offers. In the last 6 to 8 weeks, this has been a hellish environment to operate in.
And listings are way down.
Listings are way down, yeah. One of the, I guess, I don't know if you want to call it an advantage, but when you're dealing in properties that are kind of the $2-3 million range, the majority of people aren't transacting on that stuff, right? Especially if it's an investment property. So we do have a little bit more time. We do have a little bit more grace than if we're fighting over a $1.1 million investment property. There's tons of people that are after those kind of things. Right. But when we're playing around the 2.5, 3.5, there's time for negotiation. Let's put it that way.
Well, that's nice.
Well, I mean, we have a
sometimes
we have a,
not all the time, but
we have a $3.8 million fiveplex listing right now. It's a pocket listing, and awesome rents, like $18,500 of rents, cash flows as is. So anyway, point being is that there still is stuff that the competition isn't necessarily there for this type of product. So you can still find really good stuff.
Just to highlight, you're allowed to sell real estate publicly because you're licensed realtors as well. I don't know if we covered that yet. Right?
Yes,
we are licensed realtors.
They're not here, not on the show breaking the law like some other people do.
He's head of realty, so you should talk to him. Don't talk to me.
Yeah.
So hopefully, can you? What were the rents on this $2.5 million fourplex?
Oh, I don't remember them off the top of my head.
12,500.
Matt's always really good with numbers off the top of his head. I'm terrible. But
And names.
And names.
He doesn't. He barely remembered your name.
Yeah, I'm glad it says your name everywhere in this room. Otherwise,
His name is Mr. Hamilton,
Mr. Hamilton.
according to that license plate.
yeah, I was expecting to see that on the car.
I see.
I took it
see
off
that
the car.
I see that it's dented. So who did you?
Yeah, I think
who
I
did you
parked
run
next
into?
to you, and it wasn't.
It's actually just trying to get it off the car because it's old. Yeah. Yeah, I don't remember what else it was. It was just like stuck on. That's
Yeah.
He's bad with faces. He's bad with names. I'm bad with faces. So together we make a really bad.
One
team.
brain.
Also, we have a green plate on the car, on the new car. So
Oh yeah.
you
that's
need
right.
that green plate, for driving the HOV. So
Oh.
I couldn't reuse this. Like, that doesn't get me HOV
Well,
access.
people don't recognize that Tesla already means green, and
Yeah, good point. Yeah. I don't know. Yeah, I didn't think
this
about
isn't
that.
a Volt.
Yeah,
Yeah, I didn't think about that. Like, yeah, I know it's not a green license plate, but
it's a pretty recognizable electric car.
yeah, good point. I'll stick it back on then. But yeah, it is a little dinged up, the whole plate. So we don't want to throw shade at any other people's investments. But Matthew, before we were recording, we were talking about investing in Alberta because it's a hot topic. Because I know you mentioned before we were recording you don't spend much time on social media, but there's a lot it's been in the news. Like BC and Ontario, people are leaving to go Alberta.
Mm-hmm.
Makes sense. I think Calgary's beautiful. A little too cold for my liking. My family's all here too, so I won't go anywhere personally. But there are people flying out to invest, but like you have experience. And the reason why I also pick on you as well is because I think it's always wise to speak to someone who has nothing to sell you in Alberta, right? Because literally, I have Alberta Bulls in the show, right? And they're not hiding anything. They have whatever to sell. It's totally cool. Nothing wrong with selling stuff. We all sell real estate here.
Yep.
And we made people a lot of money, right? So it wasn't a terrible thing that we advised them to purchase real estate that we earned a commission off of. So what was your experience like in Alberta?
Years ago, I think when I was younger and very enamored by the shiny object, all of us here and a lot of the people who come on your show are going to be part of the old Rain Guard, right? And so one thing that Rain used to tout a lot of was cash flow. And back in my earlier days, I think Rain used to also put up those top 10 towns, yeah, right? Yeah. And
I remember those.
I haven't seen one of those in a long time, but Edmonton topped the list.
Yeah.
There was top 10 Alberta towns, Ontario towns, BC towns, and Canada. And Edmonton was at the top of the Alberta one and the Canada one. I was like, oh,
number one on both.
There we go. Let's go.
And Calgary was number one and number two on both as well, in Alberta and in Canada.
Yeah, and so. And a lot of the Rain top brass invested there. I'm like, okay.
Oh, just to give context for the listener, like we're talking about like 2008, 2009.
Oh, this is a long
2010,
time. Yeah, long time
for many years.
Yeah.
Many years. So I don't think anyone needs to know the market that well to know like those markets were all decimated.
Yeah, this is years ago. So chasing the shiny objects. I went out to a lot of different places and to invest, and Edmonton was one of them. And like you said, I don't want to throw shade on anyone else's investments or anyone else's business models. I'll just speak from my own experience. I purchased it, a block of 4 townhouses. So I basically went in and in monopoly terms, I went straight for the Red Hotel, and so I bought a block of 4 townhouses, and a number of years later, I went to divest them. I had other personal considerations, and I wanted to bring back everything to Toronto and everything like that.
How many years did you hold them?
5 years.
Do you remember what year you got in? Because I'm going to ask you how that can compare to a local piece of real estate.
Oh, yeah, I know.
Make it feel extra bad.
I know.
This is the truth about real estate investing.
Yep.
Right.
This is, I'm trying to remember exactly when, early 2010s, like back in those days. Held it for 5 years.
So that's after the crash too. That's after the oil.
It was actually after the real estate crash in 2008, 2009. So
you still timed it right, and it didn't work
even
out.
Even from a timing standpoint, it was it was not that bad. Let me think back. 2014.
So it could have been way worse if you
it
bought.
It could have been way worse.
Right.
Yeah, I know a lot of other horror stories. I also know the type of asset I was buying also gave me a little more protection. I know a lot of people who are buying really cheap condos for like 180 grand, and like I know people who got decimated with not just the market, special assessments and stuff like that. So anyway, let's revector and talk about what happened. So I got these a block of 4 townhouses. 5 years later, went to sell them, sold them for the exact same price I bought it for 5 years earlier, and it took me over a year to sell it. Couldn't even find a freaking buyer.
And you couldn't properly sell it with an APS.
And
either.
I couldn't even sell it. Normally, I had to offer an agreement for sale. I had to offer an agreement for sale as part of the offering in order to make it enticing enough for someone to come in and buy. So if you're a little more sophisticated, if you know anything about agreement for sale still essentially means I'm in the deal. I'm down on title. I'm down on mortgage.
Yeah, you're still holding. You're still the official owner.
I'm still the official owner. The other person takes control of the property, right? And the other person dictated to me the amount that they want to put down as a deposit. So I couldn't even access all my own equity because I only got the little pittance they offered me.
How much? A couple grand? Even a couple grand?
It was like I think for the 20% down payment or 20% equity I had, I think they came in at less than 10%. So like half my equity was still locked up in this property, and I wanted to get out, couldn't get out. But this is the realities of some markets that are very boom and bust,
right.
and
it's not a small market. We're talking about Calgary here.
Edmonton.
Sorry, Edmonton.
Yeah,
not a small market.
Not a small market, and it wasn't the same experience as I had here when I was here in Toronto and
right.
investing in Ontario. And anyway, so who made money on that deal? Those pesky real estate agents.
Yep.
On acquisition, on the disposition, agreement for sale, real estate lawyers on the acquisition, on the AFS, and on the closing.
So you had 4 legal fees to pay.
And 4 legal fees. Yeah, this is all times 4 because I had 4 smaller properties, right?
So sorry, did someone buy all 4?
Someone came in and bought the block of 4. Yeah.
Wow.
Yeah, and then so
you lost money after all all the fees you had to pay.
Well, how this played out to its logical conclusion actually was they couldn't get financing at the conclusion of the AFS, so I stayed on mortgage because all I had to do was call up my lender and say, hey, I want to renew this for a year, and then I was able to get an extension fee. So that's the only money I made in this whole deal because I actually only broke even after holding for 5 years, not through appreciation, through mortgage pay down and cash flow. I managed to break even, and then that small extension fee was the only thing I made in this entire deal. So then I ended up holding mortgages even longer and not accessing my equity for even longer.
Right.
So
while inflation did.
Oh yeah. I lost money if you look at it on a real basis.
Right. Yeah, for the listeners' benefit, inflation was higher than Matthew's returns.
Yes.
Right. So in real terms, you lost money.
I lost money. Yeah. Yes. Yeah. If I had just put it under my couch cushions, I would have done better. A lot less headache too.
Is this part of the advisory program as well? How to hide money in your couch?
Well, yeah.
Hide it from yourself so you don't spend it.
Actually, hold on. Doesn't your wife hide money around the house?
Oh my goodness.
We should talk about that too much.
Where do you edit that part out?
So, I said I would ask, what would you have bought instead in Toronto?
What would I have bought, or should I have bought?
Did you have anything in Toronto, for example, at the same time period?
Actually, here's the ironic thing. My very, very first investment property was in Toronto, and I didn't know anything at the time. was working corporate. I graduated from engineering at Waterloo, and then after that, I worked for a bunch of tech companies on the business side, product management mostly. So here I was working in Toronto, and I thought I was going to do what everyone else is going to do, which was buy a condo. That's what all my friends were doing, so it seemed logical. Okay, well, I guess I'm going to buy a condo. Then I was talking to a buddy of mine, and he's like, "Why are you going to buy a condo? Why don't you do what I'm doing?" I'm like, "What are you doing?" It's like, I bought a duplex. I'm like, "What's a duplex?" And then he's like, "Oh, it's 2 units in a house." I'm like, why the hell would I want a house? I remember growing up mowing the lawn and all the crap that comes along with a house, right? Shoveling snow and just everything, all the problems associated with it too. I'm like, why would I want a house?
Because no one taught us hard assets in school.
No one. And here's the other ironic thing. My parents actually invested in real estate when I was young. But I was born and raised in Belleville, and that's where they invested. And they had a hell of a time. And actually, this is what helped us formulate the Volition business model now, because it was largely about the problems they had was largely due to tenant profile. All right. So anyway, I know you have a very widespread audience, so I want to make sure
times change, right?
Yeah, but so yeah, coming back, I was gonna. So
actually, how big was Belleville back then? Because I think it's 50,000 today.
It's 50,000 now. It was 37,000 back then. If you kept the boundaries the same, it's still 37,000. The reason it's 50,000 now is because they amalgamated with the surrounding communities.
That's cheating.
It is not a growing market, actually, from a population standpoint. But anyway, that aside. So went looking for a duplex, and because my friend told me it was a good idea, and he's like, "Hey, I live in one side, in one unit, I rent out the other, and it helps me cover my costs." I was like, "Oh, that's pretty interesting."
That's genius.
All you did was allocate your capital in an intelligent way to bring down your living costs. I didn't know you could do that. Cool. Yeah. So I went shopping for a duplex, and then I accidentally bought a fourplex, and that was my very first investment property. I still own it to this day, and that has been still my best performing property. It's a fourplex in the annex, and just I lived there for many years. It was me, then me and my girlfriend turned into a wife, and then turned into one kid, and turned into another kid. Living with 2 kids in 750 square feet is...
Matt was delayed moving into his giant custom mansion, that's why. But
so, it's not a custom mansion, it is a normal sized Toronto home.
It's a nice place.
But it was, anyway, delayed gratification. That was a part of it too. But yeah, that was the first investment property that I had bought, and so Toronto was the first market that I actually ever entered.
So this fourplex in the annex, was it something you had to do a lot of uplift to, or did the market just take care of you?
So we purchased it. This is many years ago. So we purchased it it was listed $799. It was already renovated. Turned into 4 units. So I came in not knowing anything. There was an offer date. There was no offers. So I thought, I can get this for under market or under the list price. So I went in at $768. Rejected our offer. $788 rejected our offer. $800 or $799 at list rejected our offer. And then the listing agent said, "We want $810." So lo and behold, I gave him $810. And meanwhile, I was kicking myself. I was swearing at my real estate agent. I was like, "What the hell? How could we be going over ask on? There's no other offers. Like, what the heck? I'm overpaying for this thing."
Right.
That $10,000 now, as we all know, is a rounding error. Right? Like it's less than a rounding error.
I'm sure someone would gladly pay you $10,000 for this property right now.
Yeah, probably. They would probably
give you fair market value and $10,000 for your pain and suffering to take that property off your hands.
Yeah, I think $10,000 would probably get the closet, maybe less than the closet. So yeah, I mean, I've refinanced this multiple times over the years, and market value is obviously much higher than that. And acquiring fourplexes.
What do you think roughly the market value is now?
I'm not a real estate agent.
You should be getting in if you re-renovate it, so it's nicer.
No, as is. Come on.
As is. I don't know. Low 2s.
That's
that
right.
should be.
I refinanced
quite
it.
Doable.
I refinanced it. I think it appraised at $2 million like 4 years ago.
Yeah.
So.
Oh, so it's worth more than that then.
It needs a bit of work.
Yeah, it's a little. It's. I've owned it for a few years
Yeah,
now.
slumlord.
But no, but like the thing is looking at this upside potential. I can build a garden suite on it. It's actually, knowing what I know now, I knew nothing back then. All I knew was, I knew how to work. I worked in business, so I knew how to run like a business case and a business model on it. I know how to run financials on it, but I didn't know anything else. Knowing what I know now, I look at the zoning on it. For example, the density is 1.0, not 0.6. 0.6 is typical in most residential areas. 1.0 gives me the ability to do a lot more with the property. I can add a lot more square footage as of right. I can go up, I can go back, I can build a laneway suite on this thing. So yeah, when you now with a more sophisticated lens, I realize all that I can recognize all this upside potential. And this is the type of stuff that we try to do with our investors as well. We look beyond just, you have so many people who call themselves, you must see this all the time too. You have all these people who call themselves investor realtors, and really they're like, okay, Mr. Client, here's the income, here's the expense, here's cash flow. Wow, I'm an investor realtor now. And the reality is much different. There's, legal status and permitted use, there's zoning, there's,
building code, fire
Yeah.
inspections.
There's 1,001 things that go along with this, right? And so that's, realizing that kind of upside potential or being able to recognize it is part of our offering as
Because
well.
you're in a fourplex, like the fire safety standards is like
Much different.
most people have no idea.
Yeah. And then part of what we do with clients too is we have advisory on the real estate side, but one thing that's unique is we also offer advisory on the construction side. So a lot of our clients who have the financial means and the wherewithal, let's say, to want to go through a single family to legal luxury triplex or legal luxury fourplex conversion, it's not a trivial thing. Like, it's not like you just get some plans and submit them to the city and away you go. It's not that simple.
No, it's not.
And so a lot of it, navigating COA, getting the right architect, the right engineers, surveyors, and understanding things like side setbacks and minimum basement ceiling heights and two methods of egress and fire separation and the 1,000 other things. So one of the things we do is we handhold clients through that process. So Florence is the head of our construction department, and she offers a construction advisory to help people step them through that process.
And even on acquisition, you get some of these things wrong. Like you get, I don't know, you're looking to do a fourplex conversion. You don't know that right now city's pushing for 400 amp service on anything that's 4 units and up. You start to have to upgrade your gas, your electrical. Your estimates could be off by like $50,000, $60,000, $70,000.
It's 400 amps you have to bury.
Yeah.
You can't run that over in the air like 200 amps,
Right.
for example.
And a regular residential agent won't know this.
Yeah, you can't get that
No
stuff
way.
wrong. Like you get it wrong, it just kills your business case, right?
Well, no, the novice buys it and then they find out later.
Yeah. Well,
You're left holding the bag.
Yeah, don't be left holding the bag.
Yeah.
So Toronto's definitely possible. And then I jokingly asked at the beginning, so you guys have kids?
Yes.
Buying them a house in Toronto?
So we did. So we have a house that's technically for our daughter. The life plan was actually for us to move down into that area at some point in time because it's in a really good school district. The reality is I'm antisocial country bumpkin, and I like being far away. We did
in the farm capital of Aurora.
Yeah. Oh,
Yeah.
dude. There was a point in time where we were living in a place with well water and septic systems.
I've done that.
I love that. Like I love just sleeping with the windows open and hearing nothing. But I didn't
That
want my
creeped me out.
yeah. Oh man, I didn't want my daughter to grow up to be socially awkward and have no friends.
Like Dada?
Like dad. So I was like, oh, we better move into this city. So Aurora is our move into the city. But yeah, but technically she has a place downtown. Yeah.
Oh, and we haven't covered it yet. Jeez, we're running out of time too. It still makes sense to buy in Toronto because you've seen the same headlines for the last I don't know how many years. Bubble, bubble, bubble. Everything's a bubble.
Even a broken clock is right twice a day, right?
Yeah. Which is funny because I feel like sometimes I've been right. Oh, I was right. Of course, it's been like once in 12 years.
So, I mean, the short answer is yes. The long answer is it depends on where you're investing, right? So, if you are buying, a heavily non-cash flowing place in a part of Toronto that is not going through gentrification, where you don't have the infrastructure programs happening, then that's a bad investment. Then you are just paying inflated values right now. So I think more than ever, like, it really is location, location, location. And I've always spent a premium to get the best locations, because that's how your real estate improves in value, right?
Mm-hmm.
So,
well, here's a quick question. For example, like, how big is that fourplex? How many square feet, roughly?
oh, each unit is about 11 or 1,200. That's
Those are
pretty big.
enormous.
That's
big.
big. That's unusual.
Yeah.
So we're talking about over 4,000 square feet
It's big. It's a big
for
place.
$2.5 million.
Yes.
My fourplex is not like that. They're like 800 square feet per
'Cause
floor.
Each unit is 3 bedrooms plus a common area. So
I'm the Asian that failed math.
it's okay.
For the listener, I'm sitting across from 2 Asian engineers, so they're laughing at me that I have my calculator out.
The worst part,
business, man. You're not that far off.
the part that Matt always gives me a hard time is I'm the one with a math degree and I can't do mental math. Like,
So $625 a square foot.
that sounds about right. Yeah.
Why would someone buy a new pre-construction condo for like 1,700 square feet or whatever?
We don't advise people to do that.
Because they're going to pay basically triple that, almost triple that, and not that much more rent
So you're
per square foot.
Yeah.
Yeah, you're honing in on a very astute concept, and that concept is Toronto is a very big place. Toronto is not. You can't just say I invest in Toronto, because Toronto, there's literally we looked this up. There's like 151 neighborhoods or 156 neighborhoods or something like that. I think it was like a year ago. So we run a monthly meetup group. It has now grown into the largest the largest real estate meetup group in Toronto. We have like over 4,400 members, I think. And it's the second largest in Canada now. The largest one is run by a buddy of mine out in Vancouver, but he doesn't keep up with it, so which means that we might overtake him one day.
Right. You're the largest active.
Largest active one, yeah. But we'll start using that.
Yeah.
Largest active. So, but Toronto's a really big place. So I think about a year ago, we delivered a meetup called, I think it was entitled Toronto's Next Hottest Neighborhood. So we literally went through a bunch of different neighborhoods looking for where the opportunity was. So we've analyzed all these, so you don't have to, because Toronto's a really big place. So, Leaside's a really nice neighborhood. Does that mean I invest there? Mount Pleasant Davisville is a really nice neighborhood. Does that mean I invest there? Yonge and Eglinton. Insert nice neighborhood here, right? And there's a lot of people. Or another big one, Willowdale. Oh, I see a whole bunch of people, buying a 50-foot bungalow and then knocking down and then building something. That's a good investment, right? Those are not investments. Those are speculative at best. Those are the same. That's the same as going to Vegas and putting it all in black, right? Because you're basically banking on, you're just hoping for the best, essentially, right? And so those are not investable business models, in our opinion. Those are speculative bets. Good investments entail, this, at the end of the day, actually, investing is the wrong word. We are running real estate businesses. Every single property we buy is another business. And so due to the fact that we're buying businesses and operating businesses, we need to know everything about that business. We need to know sales and marketing and advertising. We have to onboard staff and property managers. We need engineers, or we need real estate agents. We need mortgage brokers. We need real estate lawyers. Like, you're running a business. If this was purely just an investment, I'd be buying a share of Apple or Google and letting Tim Cook run the show, right? But this is not just an investment. So as a result, you really need to hone in on exactly where an investable business model actually works. So to cut through all the crap, the short answer is in the residential neighborhoods surrounding the downtown core. So downtown core, all condos. So according to kind of the Volition mindset and where the opportunity is, it's not in condos necessarily. It could be a stepping stone, but you want to get to land. Why? Land is a valuable asset. there's a ton of sayings that go along with this. Buy land, they're not making any more of it, or whatever it is that you want to insert here. But land is valuable. And as the Manhattanization of Toronto continues to occur, many more condos can go up, but if you own a good parcel of land in proximity to the downtown core, that has a lot of upside potential over time. So what you want is a business model that allows you to own land. But the problem with real estate is that the land itself is not an income generating asset. So you need a building on top of it. The building is actually a depreciating asset. I mean, you know this better than anyone else due to the fact that your wife's an accountant, right? It's a depreciating asset, but it's a necessary evil to make it an income producing asset. So what do you want? What do you have to do? You put a building on the land, or buy a building that's on the land, and then get it into a rentable business model. But the reason we have to get several units under one roof is because of densification. The economies of scale allow us to get to cash flow neutral in Toronto. You asked this earlier, and you're like, hey, what is it that people used to buy back in the day? People could buy single families back in the day. They could buy duplexes back in the day. Those days are long gone. We have to get to triplex, and a lot of triplexes don't work either. It's the right triplex. Triplexes, fourplexes, the densification is the key to allowing us to generate the income we need to hold the asset over the long term to let time to do its thing. Mm-hmm. Great. Now, the question is, who do we rent this out to? We told you the professional millennials, 2 to 5 years out of school, university educated, all the rest, right? At a good job working in downtown Toronto. Why? Because those people pay their rent. It's highly unlikely that a consultant at Deloitte or an accountant at PwC doesn't pay their rent to the point where you are getting a court order to garnish their wages and you're calling up HR and asking them. That generally never happens. They pay the rent. Number two, they
care about their credit. Right?
Sorry?
They care about their credit.
They care about their credit. The reality is these people
and they have the money to pay.
Yeah.
The reality is they're eventually probably going to be homeowners or condo owners themselves one day, right? So the second thing is they take care of their place. They take care of their place. Why? This profile, they want nice things, they want it now, and they're willing to pay for it. Do I think that they should pay $2,800 in rent? I don't think they should, but I'm not their financial advisor. The reality is they will pay it, and they want a nice place. They want a nice place, they want it now, because they want to be able to have their friends over and entertain and host, and they want to impress their girlfriend and boyfriend. So they want a nice place, and they're going to take care of their place, generally speaking. The third reason is because they're a very transient tenant profile. They don't stick around. 12, 18, max like 24 months, they're moving on. Life changes for them, right? They'll move for a job. They'll move because they're moving in with a boyfriend or girlfriend or whatever, right? They're moving on in their lives versus lifers. People of generally speaking, very broad strokes, but people of a lower socioeconomic demographic tend to stay much longer. Why is this important? This is important because as street rents are going up, 5, 8, 10%, whatever the number is, we model at 3%, but we know generally it's a bit higher than that. As street rents are going up, we want to capitalize on those higher rents. Is it because I'm greedy and I just want higher rents? No, actually, if you look at for example, the Volition business model, part of it is that, and every sophisticated investor out there is going to understand this, you're going to want to refinance, do an equity takeout. When you have the equity takeout, your mortgage is higher, your mortgage payments are higher. You need to hire rents in order to capitalize on the refinance. Otherwise, you're going to be into cash flow negative territory.
Right. And it's not available with the condo.
None of this works. None of this works in the wrong business model, in the wrong areas, catering to the wrong tenant profile, catering to people who don't move. Right. And so who we focus on then are the 20 to 25% of those millennials and Gen Z profile who don't want to live in the concrete jungle. So in the residential neighborhoods surrounding the downtown core, being Annex, Little Italy, Trinity Bellwoods, Little Portugal, Dover Coals, Emerson, Dufferin Grove, Lansdowne, Roncy, some of those areas. On the east side, it's the East Yorks, the Riverdales, the Riverside, Leslieville, Plater Estates, beaches, upper beaches, a bunch of those areas. These are the areas that our tenants want to be in. And we know everything about these tenants, essentially. Every time a tenant applies for one of my units, I do the equivalent of a financial rectal exam on them. Right? I know more about their finances than they do, actually. And so I know who these people are. I know what they want. And really, it's just a matter of understanding who your tenant profile is, what they want, and then giving it to them, and then wrapping that all in a business model that actually makes good financial sense. So that's essentially the Volition business model in a nutshell. It is a little bit different than how most people invest, where I would say, they throw shit against the wall and see what sticks. This is really the same as in business. And when you're developing a new product or service, it's identifying your customer first and then building a business model or a product or a service around them, as opposed to just buying and hoping for the best. So it has been a very thought through approach and a very comprehensive business model that accounts for a lot of these different things.
And the business model has changed. We mentioned how single families used to rent out. Last time I had Ming on the show, we talked a lot about triplex conversions.
Mm-hmm.
You buy like a 2.5 story semi, you dig out the basement. We're talking about fourplexes today.
Mm-hmm.
What's next? Are you? Is there any opportunity for example, to condominiumize any of these multis, or what is next? Sixplexes?
So
7plex
I
conversions?
think then the increasing.
Wasn't it just passed recently, like fiveplex by right in Toronto?
So 4plex by right.
Okay.
But they're one of the Toronto's doing a lot of right things to make.
They're the most progressive in Ontario by far. Not even close.
Absolutely. Like it was just yesterday, and I haven't caught up to see what happened with the bill, but it takes a lot of red tape away. It takes away appeals. It takes away development charges. All stuff within the city's control, which is excellent. Does not sidestep some of the building code stuff. I just want to emphasize that for people who are thinking about doing this. You still have to make a safe property.
Oh,
and it still
terrible.
has to be, and it still has to be serviced as required. So to answer your original question, which is like, what's next? I think we'll continue to see a trend of densification. Triplexes still make sense. So they're still within the realm of possibilities, but we are sliding more and more to more density. I think maybe 10 years from now, we're going to be into 4, 5, 6. That's going to be the sweet spot. And I'm not sure what's going to happen beyond that, because I think if there's not changes to allow a regular residential purchaser of higher unit properties, you won't have an individual who's buying homes anymore. It's just going to be commercial owners. Condomization, I think we'll start to see more popularity of it. We already have clients who are asking us to walk through that process with them. We're not condomization experts ourselves.
Right. So have people been doing it in Toronto?
Yeah.
Really?
Yeah.
So for listeners' benefit, that means they're turning I'm talking about specifically to a small multi, like a triplex, for example, and they're turning each unit into a separate land title in terms of making it a condo ownership for the building.
Yeah, so we're working with one of our clients on just that right now.
Yeah, we have a few.
So we're talking about way bleeding edge then? So you don't have comps or nothing? You have no idea the uplift yet?
Yes, way bleeding edge. That is an excellent way of putting it, because some of the work we're working with her on is trying to figure out ARVs, sale prices, that kind of stuff. And
property tax, you have any idea what the property tax is going to be?
It's very early days. She's working through it with architects right now.
For the listeners' benefit, one of the reasons one would want to condominiumize is that generally reduces the property tax on the property.
Yeah,
and it also gives you a way to exit.
It's exit. Yeah, exactly. It's lift and exit, because you're essentially creating more affordable housing for owners, not just for as rentals.
Yeah, see, we're saints. We're letting people get into
we're
the market.
We're doing God's work here. So, but actually,
Adam
just
put that. We're doing God's work.
Just to add on to a couple of things that Ming was saying. So, a little while ago, we were tapped by CMHC as kind of local boots on the ground experts to understand, like, basically CMHC sitting in some ivory tower somewhere, and they're like, hey,
I remember the shit the CEO was saying before the current one. Yeah, sorry, you guys know what I'm talking about, but yeah, continue.
So they came to us and they're like, we have a mandate. I forget the exact number. Was it 500,000 or 200,000? Anyway, they had this mandate, and they're like, we have this mandate to try to create, I think it's like 200,000 or 500,000 more units. Because of the housing crisis. So like, and from all they can do is financing, right? So like, that's their mandate. So they're like, our mandate is to get money into the hands of the people to develop these things. So they're like, who's developing these things? How much does it cost? What are your problems? What are the opportunities? We went through this whole thing, and we're advising, like, this is basically, we're providing some consultation advisory to CMHC, so hopefully it makes it easier to get financing to try to create secondary suites and stuff like that. Really, we're talking about this whole missing middle, right? The problem in Toronto is, as lots of people know, you basically have this yellow belt, which is a bunch of single-family homes, and then you have a whole bunch of 70-story towers. There's nothing in between. And we've been fortunate. My wife and I have lived in a lot of different places around the world, and we've lived in Europe, and we lived in Asia and in Australia, and all these other places all have 4 or 6-story walk-ups, or maybe with an elevator or something like that. We don't have that here. No wonder we have a housing crisis. And so the densification.
Just pause you there. I was just reading in Singapore, they have 80% of their population lives in government housing, subsidized housing. Like, what is our percentage is like single digit, I think.
It's very low, and it's very it's because they push that problem down to the private sector essentially, right? And then they create a whole bunch of landlord-tenant laws, which make it really unappetizing for, let's say, for big developers. Big developers, big
let's make them pay HST.
The big institutional investors, they don't want to dabble in this stuff a lot, and there's a reason that developers they build condos instead of building
they don't want
rental
tenants.
buildings, right? We all know this.
Yeah. They're all investing in the States.
Yeah.
Like even government institutions who run pensions for like Canadian employees.
Yeah.
They don't want to invest here. They invest in the States. Maybe we should stop as well. Adam, kill the recording. We're going to California. We're investing somewhere else.
But it's funny, like this. So like we see what's on the forefront. We see what's coming down the pipe. We see what even government institutions are trying to do to promote stuff in certain areas. Missing middle, the densification. We see all this. So we saw this with CMHC, for example, and whether it actually leads to anything, we don't know. But we gave them some insights. But to answer your question, condominiumization, that's one. Condominiumization of multifamilies. We know a whole bunch of people are doing it. A few of our clients are doing it. But here's the other one. We talked about this very quickly. We kind of glazed over it, but I want to shed some light on it. Laneway suites and garden suites. That is a massive opportunity. So in Toronto, there are lots of places. You don't in the burbs. You normally pull your car into the driveway, and that's where you park your car. That doesn't happen in downtown Toronto. In downtown Toronto, more often than not, if there's parking, it is in a laneway. And so, for those of you who don't know what a laneway is, it's basically a lane that goes down the back of the house, and you park just off of the laneway. And so that's where parking is. Usually, it can be just a parking pad, it can be a garage. But what the city has allowed as of right, according to certain restrictions in the legislation, is the building of a laneway suite as of right. You don't have to go get variances. You don't have to ask for crazy whatever.
It's like a tiny house at the back of your property.
It's a tiny house, but it doesn't have to be a tiny house.
It can be a garage too.
We've
or
actually seen
with a suite on top. Yeah.
We've seen lots of variations. One of our clients, we helped them build one with a garage with the suite on top. But generally speaking, from the economic standpoint, from the financials, it makes really, really, really good financial sense. Generally speaking, if you can build a 12 to 1400 square foot laneway, it would cost you between $500,000 and $600,000 to build, and it would generate you between $4,000 and $4,500 in rent. So 8 to 10% rule back in the rain days. Holy crap!
Yeah. This is actually field tested. We have clients who are actually doing
this. So we know this. This is not theoretical.
Right.
So
does it appraise?
This is the problem. I was just gonna get.
We're talking bleeding edge still.
Yes.
I only had Landscape on the show like a year ago.
Bleeding edge stuff.
Who did you talk to? Is it Tony or Craig or?
White guy.
White guy. Nice.
But again, we're still talking bleeding edge here.
Yeah,
it is absolutely. very, very much.
Because people aren't flipping these things; they're doing this to their homes.
Nope. We have a list of properties that have
sold.
Yeah, have laneway suites that have sold. That's like this long, that list.
Right.
So like
2-inch list.
2-inch list. Yeah.
Like 6 data points. It's like nothing.
This is very early stuff.
But from a financeability standpoint, so we'll switch gears and talk about that a little bit. So, we're even working with like Dahlia, right? So Dahlia has experience doing garden suites out in like Barrie and stuff like that. So we're working on a pilot program with Dahlia with one of our clients to try to actually get we're literally pioneers trying to get stuff refinanced. You can build it. So first of all, how do you build it? $500,000 to $600,000. If you can't reach into your couch cushions and find that kind of money, you have to pull it from a HELOC or get construction financing, right? But even if you can get construction financing, which is going to be challenging, but even if you can, the problems is going to be on the refi. Your question was astute. What's this thing going to appraise for? The problem is appraisers, there aren't enough data points, there aren't enough comps. Appraisers are conservative. Lenders don't know how to finance these things quite yet.
Especially the appraiser can't tell them what it's worth, and
we
the bank's lost.
But generally speaking, like we have a couple of data points where we can kind of back it out. So for example, a home with a laneway suite gets sold. We know what the home's worth because we can do comps on the home, and then we can figure out what the laneway suite add-on is worth, essentially. And so generally, there is an increased value. It can increase the value probably some $800,000 on a $500,000 to $600,000 build. So it's a good lift, generally speaking. Good lift. Right? Yeah. Generally good lift. But even from just the economics, this thing is a massive cash flow booster. Mm-hmm. Massive. So if you pay a slight premium on the land, call it 10% for something that has laneway suite potential, right? We didn't really have that premium too much before, but now laneway suite potential means 10% increased value, or let's say premium that you pay on acquisition. But the land basis is very little, generally speaking. But then the build, if you put it all together, this thing boosts cash flow through the roof. And once lenders and appraisers can figure out how to appraise and refinance these things, then you'll get your money back out and you'll still have massive cash flow.
And that's happening now. We have 2 clients with laneway suites who have gone through appraisals, which got very favorable appraisals for their builds.
So this is
it's just going to get better. We're still talking bleeding edge.
Yeah, we're very much on the forefront here. Yeah. So, and then,
which is what we try to do on the show. And also we're truthful about it. We are bleeding edge.
Yeah.
This ain't perfect.
Absolutely. Yes, you could go through this process and not land with the right appraisals and, Yeah.
Generally speaking, this will just be a matter of time, though.
Yeah.
We don't know if that's going to be 6 months, 12 months, or 18 months, how long it's going to take before we can start getting these refinances through and stuff like that.
But that's not a long period of time.
It's not a long period of time, especially if it takes 12 months to build one.
Rates are high anyways. Leave some cash on the property. It's okay.
Yep.
Exactly. And so, and you were talking about multi-conversions. So yeah, a lot of our clients, we have a whole bunch of clients are still doing, single family to legal liberty triplex, legal liberty fourplex. We're getting now clients who want to get up into commercial, at least 5 units in order so that they can refinance using CMHC on the commercial side, lower rates, longer AMs in order to boost cash flow. But here's the other thing that how are we doing for time? Way over.
45 minutes over.
45 minutes? Isn't the show supposed to be 45 minutes?
Yeah.
40 minutes?
Let's see if anyone made it this far.
The last one that might be of interest to your listeners is going to be around mixed use residential commercial. So one of the ways that we can start densifying is by buying in the right zones. In the right zones, especially if you're near major thoroughways, the way kind of zoning works is cities they use zoning to influence the development in particular areas, which is why residential, you're going to get residentially zoned, you get a whole bunch of residential houses, no brainer. Mixed use residential commercial along like Bloor or big streets, you'll get densification, usually retail storefronts or offices on the main floor, and then upper you'll get residential, usually 2-story, maybe 3-story. But if you look at the right zones and you look at the zoning for the area, there's a lot of places, and this is like ninja level shit, right? So if you pull up the Toronto zoning map and you start looking at it, and if you can learn and decipher what it says there, if it says like R zone, R, what typical would be like R, and then in parentheses like D 0.6, and that means residential zone, and the density is 0.6. So a normal 20 by 100 lot in Toronto is 2,000 square feet. Apply a density factor of 0.6, you get 1,200 square feet. That's how you get a 1,200 square foot home, essentially. 600 square feet on the main floor, 600 square feet on the second floor. Very typical home, 3-bedroom, nice little home in Toronto, right? In some of these mixed-use residential commercial zones, you can get density 3.0. So CR zone 3.0. You can get 3 times lot coverage. So on a same size lot, you could get 6,000 square feet instead of 1,200 square feet. And the ninja level shit on top of that is on the zoning map. Use the height overlay, and then you can see the height restrictions as well. And so you can get height restrictions of instead of 10 meters, you can get 16 meters. 16 meters means you could build up to 5 stories instead of 3 stories. So all of this means you can build this stuff as of right. You don't have to ask for permission. You don't have to go to COA. You don't have to get these crazy ass exemptions and variances. You can do this as of right. So
and it all makes the deal better.
It all makes the deal better. You reduce risk because you don't want people objecting or appealing you at COA and all that stuff. Although that seems to be going away now as a fairly recent phenomenon. But it cuts down on your development times too. If you don't have to go to COA, if you don't have to, you're not waiting six months for COA dates and stuff like that. So anyway, the point being, so we have a lot of clients now who are looking for stuff like this and land assembly of mixed-use commercial residential. Not just buying one of these things, you might be buying 3 or 5 or 6 of them, assembling them, because even though if the height restriction on this is normally go up to 5 meters, if you could assemble 6 of them. We work with an architect who's one of the best, and he's told us under the right circumstances, in the right areas, with the right city councillor who supports development and densification, not necessarily condominiumization, but rental units, let's say. They'll allow you to go from 5 stories up to 8 stories. That makes the business model even more attractive, right? So that ends up
probably go on a long time.
Probably can.
But anyway, we just want to give you a sense of some of the other avenues that are more sophisticated investors with deeper pockets and who have a little more expertise. They go into other stuff than just buying a standard triplex.
But those things are only available in heavily urbanized areas.
My caveat is that this works in Toronto. I can't say it works anywhere else.
Just my experience, it has to be high traffic area.
Yeah, absolutely.
Right.
Yeah.
So you mentioned you guys have a meetup. Where can people learn more about it?
Best place is to go to our website. That's www.volition, VOLITION, prop.com. And there's a giant blue button that says
Join
meetup or something like that. RSVP,
yeah.
You need a red button too. Choose one.
Yeah, right?
Go back to... Yeah, your parents afforded it. Yeah. You can afford a house too.
We're gonna hire you as our marketer, and then you can redo our website for us.
Just keep going, and everything will be okay.
That's right.
Or the blue button, and yeah, this is how people actually make money.
But yeah, depending on when this airs, we have absolutely no idea. Funny enough, we have a meetup tomorrow, and it's a street smart tour. This is probably not going to go out in advance of that.
Gotcha.
So, but we often have guest speakers. I think you're coming out to one of ours in May. I want to say.
Oh, May? Okay, we'll make sure this gets out for that.
But yeah,
you heard that? May 17th. This needs to go up for May 17th. So May 17th is your May event.
So if this goes up before then it probably won't, right?
No, it'll go before.
It will? Okay, so if it goes up before then you can come out and see your beloved host here up on stage.
Right, but I only have 5 minutes. I'm sure people want to learn more about Toronto and whatnot. And where else? Do you guys do much on social media?
We have a semi-active Instagram account.
Semi-active being not active.
we're not. We are that age where we are not very good with social media, but you can follow us at Volition Prop on Instagram. That's probably our most active.
Oh, is it Volition Properties?
Volition Properties.
Oh God.
I'll get it right for the listener.
Thank you, sir.
We'll have it in the show notes.
Yeah, we're not very active on social. But our meetup is very active. Yeah. It's a great place to come out and
meet other Toronto investing crazies.
Yeah. And a lot of our clients come out. So if you need some social proof, or you want to talk to other people who are literally doing this stuff that we're talking about, our clients do come out to that. And if you become a Volition client as well, we have an inner circle where it's like, I don't know, about 100 of our investor clients constantly talking about real estate, to the point where like I mute the chat because I'm like, I need to get real work done.
Right.
But,
and then like the advisory services, for example, they can find it on the website.
Yeah, I guess so.
Information's there. And if anybody wants to reach out to us via email, it's info@volitionprop.com. Happy to answer any questions.
Yeah, advisory services. We have it is an area of the company I think that differentiates us from most. Whereas I think most investor realtors or most realtors are like, hey, let's go buy that condo. We want to help you actually make a good, sound investment decision based upon your goals.
Right.
And we go pretty deep in advisory. I'm not a financial planner, but we do a very kind of comprehensive financial overview to see where you're at, and see where you want to go, and help you build that plan to get there. Yeah.
Any final thoughts? You guys have been around a long time. Any final thoughts for...
You've been around here a long time too. It's only supposed to be 40 minutes.
No, I mean...
I'm sure you get some common questions from novices, for example. What would you say to them?
I think that it goes without saying to take action and do hard work, but I would add on, don't beat up yourself when you make mistakes, because we've all gone through. There's an element of luck too, right, to any success, and I think that's also to keep in mind, right? Sometimes you can do the best due diligence and do the best underwriting research and still end up sometimes in a place you don't want to be. So try to mitigate that as much as you can, but don't beat yourself up when it doesn't go well.
I'm gonna add on to the whole luck thing. So one of the things I think about when I think about luck is really when opportunity meets preparedness. And I think that if things can go awry, but I think that as long as it's a risk mitigated approach, I think that's the difference between a sophisticated and astute investor and one who just throws it against the wall and see what sticks, or someone who chases maximum cash flow to the detriment of all else. Because if you understand that it's not just about ROI, it's about risk-adjusted ROI and headache/grief-adjusted ROI, if you will. If you understand those concepts, I think they'll help guide you towards the right investment decision. And it's part of the reason that when we talk about our business model, the Volition business model, we liken it to blue chip stock investing, if you will, right? Obviously there's differences, and people will go, oh my God, like how could Toronto be risk mitigated? How could Toronto be equivalent to the blue chip investing? But if you dig deep into economic fundamentals and you understand the fundamentals that actually underpin Toronto as a market, I think we'll come to a very similar conclusion that actually it is risk mitigated, right? So, but what I want to leave people with is is a different concept, and what I want to leave people with is it's not about buying cheap; it's about buying smart. Buying cheap is cheap for a reason, and I think that if you approach things in a more sophisticated manner, in a little more holistic of a manner, a little more strategic, a little more sophisticated, a little more well thought through, I think it'll lead to better investment decisions. Not to say that some of these other models don't make sense. If it is part of your aspiration for maximum cash flow and it's part of your operational excellence to be able to mitigate those risks and handle those headaches, great, go do it. But if it's not, and you're just chasing maximum cash flow because the guy over there did, I think that could lead you awry. And this is unlike stocks, where in stocks it's very easy to unwind a position if you've made a bad call. In real estate, it's a lot more difficult. There's a lot more friction. It takes a lot more time, a lot more energy, and so do yourself a favor and start off on the right foot.
Yeah, and run your own numbers. Don't believe anyone else's.
Absolutely.
Right? Units don't matter. Someone tells you they have 100 units doesn't mean they're making money, because we all know people who've lost their shirts owning 100 properties.
Yep.
They'd be better off owning nothing.
Don't get enamored.
Stick it in the mattress.
Don't get enamored by people who have all these doors and stuff. Really, my metric is actually it's not so much I have X number of properties or doors. It's how are you doing with regards to your own path of success. Like how are you on? How far along are you on that journey? Right? Because everyone's metrics are different. Like, I know people who own just a couple of properties, a couple of really good properties, and those couple of really good properties, by other metrics, it's not very sexy, but really they did everything right. They built the equity. Maybe they had downsized to those two properties after having a larger portfolio later or whatever. But those two properties are really helping map to their success.
Right. But you're still talking about someone who's like free and clear $4 million. Like, that's a lot of money.
Yep.
Exactly.
Right.
So it's a much
so
different
no one should
conversation.
poo-poo on that.
I know. Yeah, exactly. And we all know now through this conversation, it's really understanding the relationship between that equity and cash flow. You can turn equity into cash flow, right? And so understanding these kind of concepts, and I think you're doing your listenership a really awesome service in helping raise the bar and elevate everyone around you in terms of the financial education, because you don't learn this stuff anywhere else. Yeah. You don't learn it in a book.
You're not going to learn it from someone selling something.
You don't quite, yeah. I mean, you're not going to learn it from your financial advisor.
No.
Right? Like everyone really has an agenda. And so I think something that what you're doing here, having a wide breadth of different people come in, yes, people obviously have certain things that they want to sell, but generally speaking, it's very unbiased. Generally speaking, it's very widespread with a lot of different perspectives. Yeah. And I think that that type of education, I think, is what levels everyone up.
Right.
And so,
and transparency. You show properties and you give them the numbers, and you expose people. You connect people with your own clients. Yeah. That's very transparent.
Absolutely.
Right.
Absolutely.
Like because not everybody does that, and I know lots of people who are very quiet about their losses. So it's not the sexiest thing to talk about. No, it's not. And then just the Canadians just want to be nice. They think it's their fault. So we'll leave it at that. Thanks so much for coming in.
Thanks for having us.
Thank you. It's very nice to catch up with you after all these years.
Yeah, and you have way more dark hair than I do. I need your secret.
Thank you for watching. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.